Profit season set to kick off with analysts wary of falling earnings. Auction numbers soar as investors rush to sell properties. And for the first time since 1966, the amount of cash in the economy has fallen. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Monday, the 24th of July, 2023. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. A story about 1966. Not many stories I can say, never in my lifetime. This time round, I can. I'm excited about that story.
It's very exciting. I'm looking forward to that one. I'm also looking forward to your interview that is coming up after the show today with Chris Breike. We love talking to Chris. He's the founder and CEO of online investment advisor StockSpot.
Yeah, so they've done some work on the types of exchange-traded funds investors are using, and there's kind of been a bit of a push into bond ETFs. We don't talk much about those. Mostly we talk about equity ETFs. So we talked to Chris about bond ETFs, but then more broadly about the type of exchange-traded funds investors are buying at the moment and what he thinks will happen going forward. Great chat.
Yeah, I love hearing as well about what people are not buying as well.
True.
It's always very, very intriguing. It's coming up a little bit later on. It is well worth a listen. The main story, though, this morning, it is a very big week for the Australian equity market with the unofficial kickoff of the June half reporting season with miner Rio Tinto reporting on Wednesday.
That's right. So Rio always starts off on sort of a couple of days before the actual season kicks off. So officially, it starts in a week's time. But there, Rio, we mentioned, and there are some retailers later in the week. Investors aren't overly confident about the profit reporting season, with downgrades in earnings forecasts expected. While the numbers, the results, are based on the 2023 financial year, analysts want to know what companies think is going to happen in the 2024 financial year, this current financial year, and that's what drives the share prices. The widely held view is that, thanks to higher interest rates and a slowing economy, earnings this current financial year will be lower than last financial year. Now, that happened during the COVID pandemic, but otherwise, it really isn't very normal for earnings to go backwards. While top-line revenue will be a focus, analysts want to see companies controlling costs. That'll be hard given energy prices and much higher wages bills. In terms of earnings disappointments, energy companies will, in all likelihood, lead the way lower because commodity prices have come off compared to the previous year. According to UBS, the investment bank, financial and materials companies could also go backwards this financial year, while utilities, healthcare and industrials should grow profits. Another sector that'll be very interesting to watch is consumer discretionary. We've already seen a bunch of downgrades in that sector. Harvey Norman, Adairs, Baby Bunting, Universal Stores, Best and Less, Dust, the candle maker, love their candles, Dust, the candle maker, they downgraded as well. Plenty to look forward to.
Sean, as a business journalist, how much do you love reporting season?
It's great because you really understand what's going on, but wow, it's busy.
Oh, yeah. Yeah.
So what it is, you go through business, and I always remember this working at the Fin Review and the Herald and the Age. You'd be doing it and you'd think, I must go back to that story because there's a lot in that, but I just don't have time today. And of course, 6 months later, when it comes around again, you think, oh, I should have done that. This time around, though, I'm going to try very hard to keep some of the good stuff aside so we can roll it out over the next few months.
Oh, very good. Especially if there's a story about Dusk and their candles.
Love their candles.
I never knew that about you. I never picked you for a candle guy.
I'm not a candle guy, except in recent times. I don't know, just maybe my daughter's getting into candles, or I'm always buying candles for her, and suddenly Dusk is sort of appearing as one of the retailers I attend.
You've got a Dusk loyalty card. Now, Sean, it's a massive week as well for the economists this week because we've got June quarter inflation data due for release on Wednesday, which will kind of give us an indication of how many more rate rises are on the horizon.
That's right. Consensus seems to be that inflation for the 12 months to the end of June will come in around 6.2, 6.3%. That would put the June quarter inflation reading at about 1%, which will be the slowest increase since September 2001. That's good news. Market economists think that pace of price increases alongside last week's strong labour force figures, where the unemployment rate came in at 3.5%, will probably be enough to trigger another rate hike from the Reserve Bank. But there is plenty of uncertainty around at the moment, and weaker figures might just result in the bank holding off when it meets next Tuesday.
I reckon instead of a Dusk loyalty card, you should get a Dusk loyalty candle.
Oh.
And so that basically when you go in there and you buy something, they snip your wick just a little bit. And when you get to the bottom of the candle, you get a free candle.
I have nothing to say about snipping your week. Go on.
All right. Local markets. How did they finish up on Friday?
The S&P ASX 200 closed down just a bit, dragged lower by tech stocks after a weeknight on Wall Street. For the full week last week, the local bourse finished flat. On Friday, BHP and Santos jumped 1%. Telstra, Woolies and Woodside Energy finished about 1.5% higher. The tech stocks dropped back. Xero was down 4%. WiseTech Global and REA were both down around 2.5%. One notable on Friday was Gold Digger Newcrest. Its share price fell 5% after its suitor, US-based Newmont, reported disappointing quarterly earnings.
And what's happening in international markets?
Well, it's June quarter earnings season on Wall Street as well, but it's very early in that season with about 17% of companies having reported so far. 78% have beaten expectations, which is slightly above normal. Consensus is that earnings in the US will fall by about 7% during the quarter, thanks to the slowdown in the economy. Some of the big tech stocks have already reported. Tesla and Netflix both disappointed investors. The US Fed is also meeting this week, and it's expected to lift interest rates in the world's biggest economy by about 25 basis points. But the hopes, I suppose, are that they'll downplay the likelihood of further rate rises. Very busy for the central bankers at the moment. The European Central Bank meets on Thursday. It's expected to lift rates by 25 basis points. The Japanese Central Bank, Bank of Japan, it meets on Friday, but it is likely to keep rates on hold. And finally, Michael, the Aussie dollar starts the week worth 67.3 US cents.
I should have mentioned this before, Sean, but I was very distracted with all this talk of wick snipping. But Stephen Koukoulas, our resident economist, has a lot to say in today's episode of Fear and Greed, The Week Ahead. So you can find that one on the Fear and Greed playlist or at fearandgreed.com.au. He is always worth a listen every Monday, don't you think?
He's always, especially on a week where you've got big data coming out, like in the inflation numbers on Wednesday.
Yeah, absolutely. All right, we'll be back in a moment with the rest of the day's business news. Sean, investment homes are hitting the market in growing numbers with higher interest rates and taxes pushing investor listings to near record highs.
Almost 1/3 of all auction listings in Sydney and Melbourne last week were investment properties, according to agent Ray White. Just a week ago, in Sydney at least, Ray White said that number was just 15%. They jump around a bit, but according to investment house Jarden, 40% of listings in Sydney during June were investors, 36% in Melbourne. The selling by investors is helping push up the number of auctions. Last week, across the capital cities, there were 1,729 homes that went to market, a preliminary clearance rate of 71% for the week, which was actually down a bit, down from 72.3% the previous week. What all these new investor houses does, of course, is put downward pressure on prices. So it'll be very interesting to watch. Sydney and Melbourne both had close to 700 auctions over the last week. Sydney had a clearance rate of 75% or just under 75%. Melbourne was 68%. That's the first time in 3 months that Melbourne has fallen below 70%. If we look at the other smaller capital cities, Brisbane's preliminary clearance rate was 66.1%, Adelaide 74.6%, and Canberra came in at 71.7%, Michael.
Sean, Republican presidential candidate Vivek Ramaswamy has said that Australia should step up its defence of Taiwan, promising that if elected, he would boost US submarine production to ensure the centrepiece of the AUKUS agreement is delivered on time to defend the Indo-Pacific from China.
Yeah, so the biotech and funds management entrepreneur who's amassed an estimated wealth of about $1 billion Aussie dollars has surged in the latest polling. If court cases against Donald Trump were to force him to bow out of the primary election race, Mr. Ramaswamy is well positioned to overtake Florida Governor Ron DeSantis as the most favoured candidate. That's according to recent polling. Ron DeSantis has been a front runner for quite a while outside Donald Trump, but his fortunes aren't so good at the moment. Ramaswamy told the Financial Review that he would enable greater US market access for trading partners, i.e. Australia, and certainly those trading partners willing to fight China's economic coercion, and that the White House's diplomatic language of de-risking from China was a weak alternative to decoupling.
I like this story. This is the one that you mentioned at the top of the show, Sean. The amount of cash in Australia fell last financial year for the first time since dollars and cents were introduced in 1966. with $1 billion in notes disappearing from circulation in the past 12 months.
Yes, we are peak cash, which I must say was slightly surprising because I thought that must have happened a few years ago. But every year since the transition from pounds and shillings to decimal currency, the total value and volume of notes in circulation has increased. But that reversed last financial year with a particularly large fall in the number of $50 notes, according to a story in the Sydney Morning Herald and The Age. Despite the rise of touch and go, direct payment, debit cards over the past decade, the number of notes has actually been increasing. It soared during COVID, even though many retailers moved to contactless payments systems. I don't know whether you remember that, but some of the stories we were talking about then, people were literally putting notes under their bed to save, According to the Reserve Bank, February through to December 2020, the value of $50 notes in circulation jumped by nearly 25%. Pretty amazing. There was a 15% jump in the number of $100 notes in that same period in 2020. However, it's all come to an end. As at 30 June this year, the total value of cash in circulation fell by almost $1.1 billion. There's now $101.3 billion in cash in the economy, which is the smallest amount since November 29, and the first time since decimal currency in 1966 that we went backwards.
This could be up there as one of the stupider questions I've ever asked, Sean. Where does it go? If $1.1 billion has disappeared from circulation in the past 12 months, where? So
the Reserve Bank is always putting new notes into the economy and taking out old notes.
Mm-hmm.
And it's a supply and demand. So if people want lots of cash, then, they're going to the bank or they're going to ATMs and taking it out. And then they withdraw notes from circulation that are getting old, and the banks tend to do that when they receive these older notes. They tend to get rid of them. And so the Reserve Bank just doesn't put as much back into the economy.
Oh, that's much less kind of exotic than I was thinking. Kind of have these images of kind of people burying notes, pirates, all that kind of thing.
No, don't think so.
Oh, okay, all right, fine. It's the Reserve Bank doing it. Sure. The next story is a good one, Sean, because I love any story about airlines. Not so good for Qantas, trying to address woeful on-time performance by changing the way it boards planes. After the latest official statistics show that Australia's dominant airlines remain sharply below their pre-pandemic discipline.
Qantas will begin customer trials of new boarding procedures this week aimed at reducing queues and getting passengers seated quicker. The airline will board domestic flights in 4 sections using 2 doors, the front and the rear. You'll go from the middle of the plane to the back. Qantas Chief Operating Officer Colin Hughes said the changes will make boarding smoother and quicker for customers, adding that the latest statistics demonstrated the airline is getting better. Let's look at these latest statistics. The figures show that across all airlines, Jetstar, Qantas, QantasLink, Rex Airlines, Skytrans, Virgin Australia and Virgin Australia Regional Airlines, the on-time rate was 69% in June, and that's according to the Bureau of Infrastructure and Transport Research Economics. The previous month, it was 74%. I'm not sure that they're improving. Mind you, Qantas is probably, he was only talking about specifically about Qantas, and they have picked up. But still, across the sector, it's pretty poor.
So essentially, it's using both doors.
Yeah, but so Virgin's been using both doors forever, but Qantas doesn't tend to, but yeah.
Anyway, look, I'm learning so much today, Sean. You're educating me across a whole range of different topics. McDonald's Australia will open more than 100 new restaurants over the next 3 years to the cost of around $600 million, as well as upgrade over half its current store network. That will cost another $450 million. A lot of money going into this.
Sure is. The strategy led by new local boss Anthony Martinez is the biggest expansion plan since the 1990s for McDonald's in Australia and reflects a fresh wave of popularity, part thanks to its online delivery platforms and rewards programs, according to a story in The Australian. McDonald's wants to take advantage of new innovations such as its mobile app and online delivery. The growth will result in 30 McDonald's restaurants opening this year, which is double the normal rate of annual new store openings. McDonald's Australia aims to lift its network from about 1,020 currently to have more than 1,100 sites around the country by 2025. So, Michael, here's your quiz for the day. Can you name, you don't have to get them in any order, the top 5 fast food restaurants, at least in terms of stores?
Oh, great question. Domino's,
Yep, that's the third.
Pizza Hut,
No, not a top 5 restaurant.
KFC,
Yeah, 4.
Hungry Jack's.
5. McDonald's is 2.
Oh, so what's number 1?
Subway.
No.
Yep, 1,227.
What?
That's
Oh.
according to franchisebuyer.com, yeah.
Oh, there you go. Goodness me, the lessons, Sean, from you today.
And then the fastest growing fast food outlet,
No idea.
Guzman y Gomez.
That makes sense.
And one of the ones that's sliding backwards, Nando's. There you go.
Goodness me. Oh, Sean, wow, what a way to start the week. So much information. A-League Football Club Perth Glory has gone into receivership and had its licence revoked and a receiver appointed. Not good news.
No, not for the supporters. The club was one of the original 8 teams that started the A-League back in 2004. It actually won the title 4 years ago. It's owned by Tony Sage, and he's been looking for new investors for some months. Over the weekend, Quarterment's Andrew Knight said an orderly sale process will commence immediately. Sage said owning the club for 17 years has taken an emotional and financial toll on him. He's stepping down his chair immediately. Now, obviously, the future of players, coaches and staff is unclear. Mind you, after last season finished, 3 of the main squad remained with the club and 13 left.
Right. Now, international news. Now, Sean, London stands ready, apparently, to host the 2026 Commonwealth Games with an estimated cost of £500 million from central government, according to reports in the Financial Times.
London's Mayor Sadiq Khan is among a handful of city leaders who have expressed a desire to host the Games in 2026. Obviously, they're not going to be in Victoria. London officials estimate the event will cost about £500 million, much below figures offered by other prospective host cities, mostly because London's got plenty of sporting infrastructure already. A spokesperson for Khan said London stands ready to support if required, but noted that the ultimate decision to bid would be taken by the government. One person briefed on the UK government's thinking said the preference in Westminster was still for Australia to hold the Games somewhere. I think that's unlikely to happen, though.
All right, Sean, one last one. US giant Blackstone has become the first private equity firm to manage $1 trillion.
Yeah, fair to say private equity is now pretty mainstream. Blackstone started in 1985. It was managing $400,000 in one private equity fund. Now it manages investments in real estate, credit, infrastructure, hedge fund products, all sorts of things. As the company's president, John Gray, told Bloomberg, it's not your mother and father's private equity firm anymore, and it ain't. Globally, Blackstone backs about 250 companies in Australia. Of course, it owns Crown Resorts. It employs about 27,000 people across the companies that it invests in. Like many other private equity firms nowadays, others like Brookfield, KKR, Carlyle Group and Apollo Global Management, Blackstone is publicly listed on Wall Street. It's kind of no longer the destination for the rich. It's kind of for us poor folk as well.
For us regular people, Sean.
Yeah.
Goodness, we've covered some terrain today. Up next is the Fear and Greed business interview with Chris Breike, founder and CEO of online investment advisor StockSpot.
Yes, we're talking all about exchange-traded funds and what people are investing in terms of exchange-traded funds and what he thinks will happen going forward. And as you mentioned at the top of the show, what people aren't investing in.
Oh, yeah. It's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And if you've got a little bit longer in your commute today or you're looking for something else to listen to, why not make today the day that you go back and listen to the weekend edition of Fear and Greed? It is different to the weekday show in that it's very competitive between you and me, Sean, and we look for the biggest story and the most remarkable and sleeper stories and favourite stories. And I would say that the weekend just gone would be probably our most competitive / argumentative juvenile show yet.
Yeah, well, and the benchmark is pretty high.
That's right.
So that's a big call.
The amount of name calling.
Love it.
It was brutal. But anyway, it is worth a listen. You'll find that one at fearandgreed.com.au as well, or wherever you listen to podcasts. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 24th of July, 2023. Make sure you're following the podcast and join us online as well on LinkedIn and Instagram, Twitter and Facebook. I'm Michael Thompson, and that was Fear and Greed Business News. Have a great day.